The final way that balanced dues are created is through what's called a substitute for return. So when you have a case of a non-filer, so if the taxpayer doesn't file a return for a year, and the IRS will see wage or income information for that taxpayer or any number of other third-party data sources, then the IRS will create a return for the taxpayer. And that's what's known as a substitute for return, or an SFR. So if you're calling the IRS and the IRS indicates that the taxpayer has SFRs on file, that means the taxpayer didn't file a return. Those SFRs can simply be corrected through filing a tax return and putting something on the IRS's system. With SFR liabilities, so generally the statute for any sort of changes through examination is 3 years, with some exceptions. There's exceptions for fraud, which can extend the statute out for 6, and there's also an exception for SFRs. So any time that the taxpayer does not file a return, the IRS can technically go back and file a return on their behalf. Now, in reality, the IRS is governed on SFRs through IRM 412.1.3. And 412.1.3 says that as a general policy consideration, the IRS will usually limit SFR filings to the past 6 years. But there's a couple of factors that play into whether the IRS will file an SFR or not. So the first factor is the taxpayer's compliance history. If the taxpayer has multiple years of not filing returns, then the IRS may look at the taxpayer's account as an aggregate and may decide to batch file SFRs, or may decide to go after SFRs for 1 year. The second factor is any illegally sourced income, or any ill-gotten gains, or any criminal activity that the government may be aware of. Government agencies do share information. And then the third and probably most important consideration for the government is how much revenue is going to be anticipated from collecting on these SFRs. If you've got a taxpayer who is a fairly high income earner and has been operating off the books, as is commonly the case. So, for example, I had a situation with a client who was the beneficiary of a trust, and she'd been the beneficiary of a trust since about the mid-'80s, and she had failed to file returns since the mid-'80s going forward. And so, because of the amount of the distributions coming out of the trust that were being reported to the client and the size of those distributions, the government decided to start filing SFRs for her and eventually racked up a couple $1 million in liability. So that's a really extreme case. Most of the time I will tell you that taxpayers who are above the $100,000 range are those who tend to have SFR filings. The other thing is taxpayers who are below the $100,000 range, if they have wage and income information on file, and generally taxpayers with wage and income information on file are a lot easier to prepare SFRs for. You plug in the wage and income information that's on file, you can easily create a return and or a past due tax liability. Oftentimes the IRS will be able to see through their system through the wages and the withholdings that were issued on W-2 earners whether an SFR is necessary. So a lot of times the IRS will forego filing SFRs because they view the withholdings as sufficient. So when calling the IRS and looking at a taxpayer's account, upon coming across SFRs or years that the IRS says are not filed, it's important to make the determination on whether a return is actually needed and whether it's going to be beneficial for the client to file. And those are really important considerations to make. There are other factors that impact an SFR, that impact the decision on whether or not you want to file a return. But generally speaking, what you're looking for is whether the IRS personnel is asserting a filing requirement. Does the IRS want this person to file a return, or are they satisfied with the SFR filing?